Welcome to the deep dive. We're sifting through a stack of institutional research today, really trying to find the signal in the noise for Wednesday, December 3rd, 2025.
Right.
And our mission is pretty specific. We're trying to figure out the core tension in the market right now.
Which is this idea of headline neutrality versus a kind of structural fragility that's lurking just beneath the surface.
Exactly. So we're looking for that actionable edge by examining, liquidity, volatility, and some of these really strange correlation shifts.
And our focus to start is on the pre-market futures action. We're watching the S&P 500, the ES, the Nasdaq 100, NQ, and I think crucially, the Russell 2000, the RTY.
So let's start right there with the plumbing, the pre-market snapshot. What's the initial read on liquidity this morning? It feels a little thin.
It is. It's balanced, but definitely thin, which is pretty typical for an overnight session with no major data driving things.
Okay, so when you say thin, what does the book actually look like?
Well, in ES and NQ, you've got tight bid-ask spreads. That's normal. It indicates there's comfort for the big players. But the depth, the actual volume stacked up on either side, it's not exceptional.
And what about the RTY? You said that was crucial.
It is, because the liquidity profile for the Russell 2000 is noticeably weaker.
Weaker how? Are we just talking about wider spreads, or is it something more?
It's both. The spreads are marginally wider, sure, but the depth is significantly shallower.
Then why does that matter so much?
Because that weaker liquidity in small caps is a huge signal. Small caps are, they're the barometer for the domestic economy. Thin liquidity there suggests participants are either stepping away or, more importantly, that any sudden shock is going to cause an oversized price move in the Russell.
So it's a subtle sign of nervousness under the hood.
It really is.
And the overnight price action sort of confirms that contained feeling, at least on the surface. IS traded in, what, a tiny 0.25% band?
Yeah, very tame two-sided action. NQ was similar, though, with its higher beta, its moves are always a little exaggerated compared to the S&P.
Right. If there's a break, NQ tends to lead the way, up or down.
Absolutely. But the real story was the RTY being the relative underperformer overnight. It dipped a bit more, and it just lacked that same vigor on the recovery bids that you saw in the big cap names.
Which just reinforces that point. If the market is going to crack because of, say, economic uncertainty, the Russell 2000 is probably where you'll see that first wave of sustained selling.
That's where I'd be looking.
Now, we're always trying to spot the footprints of institutional flow. Did we see any evidence of, trapped traders? Or those sharp liquidity grabs at the overnight highs or lows?
Not aggressively, no. Which, again, it supports that idea of a neutral wait-and-see market structure.
Okay, so no obvious stop hunting.
The volume at the overnight extremes was just really light. If big players were trying to clear out stops to build a large directional position, you'd expect to see a sharp low-volume spike and then an immediate reversal.
And we didn't get that signal.
We didn't, which tells us people aren't aggressively positioned one way or the other heading into the open, and that leads to a pretty tight implied opening range.
So we're looking at what? ES around plus or minus 0.30% and NQ a little wider at plus or minus 0.40%?
That's the math. It's the definition of an orderly, maybe even boring open.
But this is where it gets interesting, because if we look away from the screens and at the macro picture, that's where the paradox really starts. We have these massive risk-on tailwinds clashing with that structural fragility you mentioned.
And the risk-on story is all about one thing: rate expectations. The market has been relentless in pricing in a dovish Fed.
What are the numbers there?
We're looking at a nearly 90% probability priced in for a 25 basis point cut at the December 10th FOMC meeting.
So a cut next week is almost a done deal in the market's mind.
And if you look out further, the market is pricing in roughly 90 basis points of total cuts for 2026. That is pure fuel for risk assets.
And the traditional assets seem to be confirming that story. Equities are strong, S&P is up over 12% year on year, and the safe haven assets are easing off. The 10-year yield has softened to 4.09%.
And maybe the most telling signal of all is the US dollar index, the DXY. It's weakening, hovering around that 99.18 level.
Which is the textbook signal.
It's the classic sign that global capital is flowing out of safe US assets and into riskier things, like international equities and emerging markets.
And yet, and this is the fascinating part, some of the non-traditional correlations are telling a very different story about what this risk appetite actually is. Let's talk about gold and Bitcoin.
Right. Gold is rising right alongside equities. In a classic growth-driven risk-on rally, gold should be flat or maybe even down.
So what's driving it?
It's not a hedge against market distress. It's a forward-looking hedge against financial repression.
Meaning what exactly?
It's pricing in the anticipation of lower real rates for a very long time and, the long-term debasement of fiat currency that comes from these prolonged easing cycles. It's a risk asset for policy reasons, not a safety asset for crisis reasons.
That's a critical distinction. And then you have Bitcoin, which just surged past $93,000.
And that's being driven by fresh institutional inflows. You have Vanguard now opening up access to the ETFs. The whole narrative has shifted. Its one-year realized volatility is down, and it's now firmly seen as a high beta growth asset.
It's soaking up capital that might have otherwise gone into small cap tech.
Exactly. But here's the warning sign we can't ignore in all this. The cracks that are appearing in the traditional 60/40 portfolio.
Right. The whole premise of diversification is that stocks and bonds move in opposite directions. Walk us through how that's breaking down.
Well, historically, if growth slows, stocks fall. But the Fed cuts rates, which pushes bond prices up. That's your buffer.
Your diversification.
Exactly. But in a world defined by sticky, persistent inflation, the very thing the market seems to be underestimating, that inverse correlation just breaks.
Why?
Because if inflation stays high, central banks can't cut rates. Even if growth is slowing down, they might even have to start hiking again.
So you get hit on both sides.
A total double whammy. Discount rates go up, which hurts stocks, and bond prices fall. Your 60/40 portfolio offers zero diversification benefit.
And that's a foundational stress point for basically every major asset allocator out there.
It signals a market structure that is fundamentally fragile, even if the day-to-day price action looks calm. Which is why we have to drill into volatility and the hidden pressures in the funding markets.
The VIX is a bit of a puzzle right now. The spot VIX is low, around 16.5, which suggests complacency. And some people are saying the futures curve isn't a healthy contango.
It should suggest stability, but you have to look closer at the term structure. Other data puts the VIX higher, more like in the 18 to 20 range, and describes the term structure as, well, as flat.
Flat, or you called it contango light.
Right. It's bordering on mild backwardation.
Why is that distinction so important? If the front month VIX future is almost the same price as the back months, what does that signal?
It signals that traders are pricing in elevated near-term risks. The demand for immediate downside protection, for hedging against a surprise in the next few weeks, is unusually high.
So institutions are paying up for that immediate insurance.
They are. It's a sign of serious caution. Not panic, but definitely not the carefree environment that a low-spot VIX might suggest.
And that caution is probably being amplified by this silent liquidity squeeze that's happening in the funding markets. This isn't a headline story, but it's critical.
It's the plumbing again. We're seeing real signs of tightness. The SOFR and TGCR rates, which are key benchmarks for short-term lending between banks, they recently crept back above 4%.
And the canary in the coal mine was the Fed's standing repo facility, the SRF.
That's it. We saw a $26 billion uptake at the SRF on December 1st. That facility is the Fed's emergency backstop for liquidity.
$26 billion isn't a massive number, but it's not nothing.
It's not. It confirms that some pockets of the financial system are finding funding tight enough that they have to go to the central bank.
Yeah.
It's a clear sign of intermittent stress.
And if you connect that to the big picture, it's all about the systemic drain from quantitative tightening, or QT. The Fed is shrinking its balance sheet, taking liquidity out of the system.
And that reduced liquidity fundamentally changes how the market behaves. It increases the convexity of market moves.
In simple terms.
It means when a shock hits, like a hot inflation print, the price moves will be bigger and faster than they would be in a fully liquid market. There's just not enough depth to absorb the big orders.
So the risks are asymmetric. Okay, so given this fragile structure, where is the consensus positioned, and what's the pain trade that would cause the most damage?
The consensus is priced for absolute perfection, a Goldilocks soft landing. Growth slows just enough, inflation comes back to target, and the Fed starts cutting rates in mid-2026.
That's the benign narrative priced into everything.
It is.
So if that's the consensus, the pain trade must be the exact opposite.
The pain trade is a hard landing that is induced by persistent, sticky inflation.
The double whammy scenario you mentioned earlier.
Exactly. Imagine we get a hotter-than-expected CPI print, say 3.6%. That forces the Fed to abandon the rate cut talk and maybe even resume hiking in early 2026.
And at the same time, those high rates finally bite, growth decelerates fast, and corporate earnings get hammered.
Precisely. You get higher discount rates and lower future cash flows at the same time. That's the mechanism that crushes both growth stocks and long-term bonds. It's where the 60-40 failure happens on an epic scale.
And the market is vulnerable to this because it's underpricing the chance of that persistent inflation. What are the structural forces people are missing?
I think there are three. First, deglobalization. Moving from efficient global supply chains to less efficient regional ones is inherently inflationary.
Okay, that makes sense.
Second, labor market tightness. Demographics, high wage growth. This isn't a transitory problem the Fed can easily solve.
And the third one?
The energy transition. The capital spending required to build all this green infrastructure is absolutely massive, and that kind of investment boom is, by its nature, inflationary.
So the market is assuming the Fed will pivot to save growth, but if inflation stays high because of these structural forces, their mandate is clear. They have to tame inflation, even if it causes a hard landing.
And that potential choice is what is severely underpriced right now.
Okay, so if the equilibrium is this fragile and the main risk is mispriced, we need a strategy. What's the high conviction thesis for navigating this?
The thesis is what we call adaptive dispersion and tail risk harvest. The goal is to generate convex payoffs. We want to be positioned for small losses if we're wrong, but massive amplified gains if that pain trade actually materializes.
Let's break that down. What are the three key components?
Component one is your core defensive layer. You maintain long-duration, high-quality fixed income exposure.
So you still own bonds?
You do, because that's your insurance policy against the other tail risk, a severe deflationary shock where the economy just falls off a cliff. The flight to safety bid will still show up there.
Okay, that's defense. What about offense, the alpha generation?
Component two. This is where we implement targeted short exposure in crowded, high beta equity segments. This is surgical. It is not a broad market short.
You're picking your spots.
We're targeting areas with stretched valuations and very low realized volatility. We're essentially harvesting the premium from all that overconfidence and exploiting that weakness we saw in the RTY versus the S&P 500.
And the final piece, the explicit hedge, which seems crucial given what you said about the VIX curve.
Component three, go long volatility. We do this via out-of-the-money or OTM options in the most vulnerable sectors. We're using that flat VIX front end to buy cheap convexity. We're positioning for a rapid nonlinear spike if a shock hits.
A strategy like this has to have a clear exit plan. What are the signals that would invalidate the thesis and force a pivot?
Three critical things to monitor. First, a sustained spike in the spot VIX above 25. That tells you complacency is over, and it's probably time to monetize those long vol positions.
Number two.
A significant credit market dislocation. Specifically, watch for high-yield credit spreads widening by 150 to 200 basis points. That's a 5-alarm fire for corporate default risk.
And the third would be the Fed.
A decisive monetary policy reversal. If central banks unexpectedly shift back to aggressive non-priced easing and start flooding the system with liquidity again, that would invalidate the short thesis immediately.
So, to summarize, the market's calm surface is really just a facade.
It is. It's masking these pockets of extreme fragility, which are being amplified by tightened liquidity and this profound underpricing of near-term risk. Prudent management right now is all about convex payoffs and maintaining optionality.
That is the perfect takeaway for today's session. And as you process this analysis and watch the open, here's a final thought to consider. Beyond the daily noise of CPI numbers, what specific structural component of inflation, be it deglobalization, labor markets, the energy transition, do you believe the market is underestimating the most? Your answer to that question really defines your long-term risk positioning.